Quitting is especially hard in the stock market because losing feels about 2 times as bad to us as winning.
If I had to buy something today and go to sleep for a decade and wake up, I'd feel pretty good about these companies being bigger in a decade than they are today. Microsoft's stake is going to be worth $150 to $200 billion. That's just turning $13 billion into $175 billion.
A lot of people like gold, and this is a very high margin cash flow machine.
Very consistent today on picking high margin, Tollbooth like businesses.
Hello, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today with my co-host, Nicholas Ward. Nick, it's good to see you today.
Yeah, good to see you, Brad. Good morning to you. Good day in the markets today, I think. So that's it's always nice to start the week on a green note.
Absolutely. And listen, what about your football record here? I know we had another week of football. You were 2-1 last week.
Yeah, 3-1. 3-1 this week. We won 40-3. I looked it up because I wanted. I don't think any of my kids watch this show, but if they do, one, they're learning something about finance. Financial literacy is very important to both of us. But two, I want to make them proud of themselves. We've outscored our opponents 125-3 in the last 3 games. So I think the topic of this week's video is sleeping well at night, and I've certainly been sleeping well on Friday nights after victories like that.
Well, Nick, I got to ask you, you gave up 3 points. Did you walk away thinking, man, I can't believe they scored on us?
Yeah, that I remember we the coaches walking off the field, we weren't happy about it. 3 consecutive shutouts hasn't happened at our high school in several decades. So that would have been a nice achievement. But we also understand these are kind of like first world problems. Very happy to win by 5 touchdowns. And we're on a bye week this week, so no game this Friday, but we hope to keep it rolling next week.
Well, hopefully that streak can continue. I was watching college football this weekend right here in South Carolina, Clemson. Man, I'll tell you. And I don't know if you've covered, college football. I know you're there at Charlottesville, obviously. But, Clemson's having a tough year, and there's a lot of people around here thinking, Dabo Swinney might get fired. But at any rate, as you know, Nick, you're only as good as your last game.
Yeah, no, and I think some people want them to quit, right? And I think that's something that you wanted to talk about this week, isn't it?
It is. In fact, I just finished this book. I wrote about this today. So check out my free letter. Our free letter is called the Wide Moat Letter. You can find that at widemoatresearch.com. So today I wrote an article called When to Quit. And this book is really great. It's written by a lady by the name of Annie Duke, and she's a professional poker player. And what's interesting, I learned in the book, this book is not about poker, by the way. We're going to talk about investing here in just a second. But what I found out in this book is that most professional poker players, and I've got a friend, by the way, Julian Rimbert, if you're watching, hopefully he is. He is a professional poker player, goes to Vegas quite often. But most of these players, they know how to quit. In fact, they quit a lot more than the amateur players do. Which I don't even consider myself an amateur, but knowing when to quit is extremely important. And this book is just I would recommend it to anybody who's interested in quitting, whether it means, quitting at the gym or quitting some business deal or quitting some stocks or selling some stocks. There's a really interesting phrase or sentence or two that I want to demonstrate here that Ann Duke explains here in this book. Quitting is especially hard in the stock market because losing feels about 2 times as bad to us as winning. She goes on to say, the best quitting strategy would be to examine all of your holdings, not just the ones at the tails of your portfolio, and decide which are going to generate the least value going forward and sell. That would maximize the value of the portfolio as a whole. This is, after all, their buying strategy, and they execute it with skill and success by using amazing data-driven strategies to generate excess returns. Now, this is, again, a really great example of this and knowing when to quit. And I know, Nick, we've got hard stop losses here at Wide Moat Research. And I know you and I have talked about stop losses over the many months here or years at Wide Moat Research. But the reason stop losses can be effective is because it forces you as the investor not to keep going down that rabbit hole. And I know we've got some great examples, and I'll point those out today in the Wide Moat Letter, companies that we had to hit that stop loss but I'm glad we did, because those companies kept going further and further and further down the hole.
Yeah, sometimes it can be hard. I think both of us are buy and hold investors, and I think like the stop loss argument, that kind of comes down to your length, to your time horizon. If you plan on holding a stock for a decade, maybe you shouldn't sell it, ever. Just hold it for a long time. So that depends on the person. But I do think, what the quote from that book, I think Warren Buffett, somebody has said, don't cut your flowers and water your weeds. Don't sell your winners just to throw money at your losers. Don't take good money and throw it at bad ideas. That's, I think, something a lot of people do, especially value investors. We always think we should buy cheap things, we should sell expensive things. But sometimes, I've learned over the years, just because something's winning is not a good reason to sell it. You got to stick with what's working. And why is that? Is because of fundamental growth, right? If things are working, generally speaking, it's because they're growing their earnings, they're growing their cash flows, et cetera. So long as that's happening, I'm a big fan of letting my winners run. And I think that quote is perfect. It's hard to take a loss. I agree. I hate losing way more than I love winning. That's why I kind of run a conservative portfolio myself. But sometimes you got to take those losses and just take that money, take whatever you have left, and put it towards your best ideas.
Yeah, in the book, she talks about creating these shadow portfolios, which is something we ought to consider here at Wide Moat Research. Is simply, we should put together these portfolios that if we would have made that loss or decided at that point to sell or decided to buy, how would those companies have done during that period of time? So I think it's really important to start looking at that. And that's something we're going to be doing more of. I'm going to devote a couple articles this week to the concept of quitting. Now, Nick, today we're not talking about quitting, we're talking about winning. And I know we've got our audience here today to talk about some winning stocks and really some high quality stocks. So I'll let you start. I know you've got 3 of yours and I've got 3 of mine.
Yeah, these are my favorite types of videos. So Brad came to me this weekend. We talked about what we wanted to do. He said, focus on your Swan stocks. So when I thought about that, what is a Swan stock? To me, it's not necessarily a stock that's got the biggest upside. These aren't the biggest winners in my portfolio. You guys saw my portfolio a couple weeks ago. You'll notice that the 3 stocks I'm going to talk about today aren't my 3 largest holdings. However, the 3 stocks I'm going to talk about today are companies that I would feel comfortable, if I had to buy something today and go to sleep for a decade and wake up, I'd feel pretty good about these companies being bigger in a decade than they are today. So I picked 1 tech company, 1 finance company, and 1 industrial. I didn't go all tech, and that may be surprising to some people, knowing that something like 60% of my net worth is invested in tech stocks right now. But that's because of disruption. When I look at NVIDIA, when I look at Broadcom, Amazon, Google, et cetera, I own large stakes in all these companies, but I can't be certain that in a decade they're going to be winners. I think they will be, otherwise I wouldn't be heavily invested. But I do acknowledge, there is a big threat of disruption, and a lot of those companies have fairly narrow revenue streams. NVIDIA, just semiconductors with a little bit of software. Broadcom, same thing. Google, search dominance, et cetera. So in the tech space, I'll get to my first pick. I picked Microsoft, and that's probably shouldn't be a surprise to anybody. I always tell people I think this is the highest quality company in the world. It's highly diversified, cloud computing, artificial intelligence, gaming, social media, cybersecurity, et cetera, enterprise software. They do it all. They're very good at it all. And they have enough money just to hop into the next trend, which is kind of the theme with them that I like so much. They have, I think, $95 billion on their balance sheet. And I'll throw up some charts here. You can see that's after spending massive amounts of CapEx in the last several years. I have a chart here. You see their CapEx has gone up 8,000% over the last 20 years. Back in 2005, it was, I think, $2 billion a year. Now it's at like $17, $18 billion a quarter. Okay. So the fact that they can invest that amount of money because they have the cash flows to support it. And here's a chart showing their cash flows, over the last 5 or 6 years, steadily rising just to kind of ludicrous amounts of money. I think what their free cash flow was, almost $100 billion last year. Most of the S&P 500 doesn't even have a market cap that high. So the rich get richer. Microsoft, they put $13 billion into OpenAI just a few years ago. OpenAI is likely turning into a for-profit company soon. As soon as that corporate restructuring is done, that Microsoft stake is going to be worth, $150 to $200 billion. That's just turning $13 billion into, $175 billion in just a few years. Most companies would have loved to have made that deal, but they couldn't do it. They didn't have $13 billion to risk on a very speculative company. But to Microsoft, that's just a drop in the bucket of their cash flows. So I love companies like this that are highly diversified, highly profitable, and they can use their cash to, kind of bully their competitors, for lack of a better term. I'm sure the antitrust people, they don't like this, but I'm kind of the boat. I'm not going to fight the trend. It kind of is what it is. I would rather, pick the big dog in the fight, so to speak, and own those shares. So I like Microsoft a lot. That's my first Swan pick. However, I will note that it's not a great valuation today. None of my three picks are. These are three companies that I currently own. I'm not buying at the moment, but I would be happy to buy in a pullback. So to make this kind of video more actionable, I do want to throw up a fast graph here. As you can see, the black line is well above the blue line and the pink custom line that I added in there. That pink line is 25 times earnings. I think for a company like Microsoft growing 15, 18% a year, that's kind of fair value, the upper level of what I would want to pay. As you can see here, 15 times forward, we're talking right about $400 a share. The company's at $500 right now, I think. So it would have to fall, 15, 20%. If you look another year down the road, though, you're only at $450. So depending on how far out into the future you want to look to kind of find your fair value estimate, it may not have to fall that much. That's only I think a 5-8% discount. So I think Microsoft's overvalued. I'm not buying today, but this is a company on any significant market event that we have, any bearish moment, any pullback. This is a company I would feel very comfortable, putting a lot of money towards, going overweight, knowing that I could hold it, for a decade, I think, pretty risk-free, or certainly not risk-free. That's not good phrasing, but low risk, high return, I think. And they keep growing the dividend every year. They just increased the dividend by 10%, I think, last week. I love that. Slow and steady growth, just compounding that snowball higher and higher. So, Brad, before I go to my next pick, do you have any thoughts on Microsoft or any of those kind of ideas? Or does the antitrust bother you? I know that's something with REITs we often talk about, how that's not a threat at all for REITs because it's so there's a lack of concentration in that industry. Does that bother you from the big tech point of view?
No, not at all. In fact, that's certainly a wide moat for the company. And all I got to say is, if this is Swan number one, I can't wait for Swan number two. So let's keep going here and see.
Yeah.
I'm anxious to see what your next pick.
Yeah, I'll be quick. So I'm moving away from tech. Like I said, I love tech. I also understand that debt fuels the world. That's not going to change. I go to sleep today and wake up in a decade. There's going to be a lot more debt then than there is now. That's just been the trend for as long as humans have existed, I think. So what company benefits from that? It's not a bank in my mind. They may, but it's S&P Global, the company that does the credit ratings. Every time a company has to raise debt, anytime there's an M&A happens, anytime a government has to raise debt, et cetera, they charge S&P Global. They want that credit rating from them. That they get a fee for that. So this is kind of a very high margin financial business that I like a lot. I'll throw up a chart here that kind of shows their different businesses. They have the market intelligence kind of aspect, which is, analytics like Brad and I use to analyze our stocks. They have their ratings agency. They have their commodity insights, which is similar to the market analytics, but for commodities. And they have their mobility segment, which focuses on car and transportation loans. They're going to spin out that mobility segment, I think, over the next year. So I'm kind of ignoring that. I own S&P. I'm probably going to sell those shares when I get them and just reinvest back into the company. But to me, this is several companies in one. I like the company MSCI that does the global market indexes. Well, you've got that within S&P Global. I like Moody's, except you've got that here too. You've got FactSet services, which Brad and I use with our fast graphs to analyze stocks. You've got that in here. So to me, S&P Global, it kind of covers about 4 or 5 of my favorite kind of financial services companies, all wrapped into one. Very high margins, overall 49.5% last quarter. Love that. And like I said, that's not going anywhere. I'll throw up another chart here, just kind of shows their revenue breakdown. As you can see, the market intelligence and the ratings agencies make up about half of their revenues. So those are probably my 2 favorite aspects of the company. Their indices is the highest margin part of the company, but I do think that there may be some AI risk, kind of disruption risk at play there. But I don't think there's a lot of AI disruption risk when it comes to the ratings agency. I think that there's going to be a lot of mistrust when it comes to AI companies moving forward, and S&P and Moody's are going to, they're kind of a duopoly in the ratings agencies right now, and that's going to stay in place. So I like this company a lot. As you can see here, I'll throw up a fast graph. It's grown earnings at a double-digit clip, I think 17 out of the last 20 years. I love compounders like that. Shares are expensive at roughly 30 times here. I put up the pink line again, 25 times earnings. That's kind of like a baseline multiple that I'm happy to pay for a company with consistent double-digit growth. 25 times forward, we're at $480 a share. So we're not that far off here. S&P's at like 510 right now. So you fall off a little bit here. The company's down from its highs. It was trading at $560 not all that long ago. When FactSet reported earnings last week that weren't very good, Moody's and S&P fell kind of alongside them. But like I just showed, S&P is a much more diversified company. So I think that's an irrational move by the market. If this company falls another 5%, I'll probably start adding shares in my personal portfolio. So I wanted to highlight this today. The dividend growth, I will note, has slowed in recent years. I think as rates have increased, there's been some uncertainty. So they haven't been as generous with their cash flows as they have in the past. But I think with a dovish Fed, I think shareholder returns accelerate here. Brad and I have both talked about how with the Trump administration, we think M&A is going to accelerate. We just published on Friday, I think, a Wide Moat Daily article highlighting our belief that there's going to be an upcoming M&A boom. And every time there's a big M&A transaction, some of that dollars trickles down to S&P Global's coffers. So there's the bullish thesis there. Brad, any thoughts before I move on to the last pick?
Great. Swan pick number 2. I use S&P every day. Obviously, as part of our research, we look at the ratings. I've launched now 2 indexes with a index partner, not S&P. So I'm very familiar with their index business. They are the gold standard. A few years ago, they acquired a company called S&L Financial, based right there in your backyard, Nick, in Charlottesville. And they were really a really great REIT research firm, and they had other sectors as well. But S&P acquired them. It was a really good acquisition by S&P. I hate to see S&L Financial go away, but S&P is you just can't ignore it. They are the gold standard. Great Swan pick. And Nick, I cannot wait for your third.
Yeah, the third one is, I'm trying to think what's another thing that in 10 years there's going to be more of than there is today, and the answer is trash. What company turns trash into treasure is Waste Management. They're the largest trash collection company in the United States and in the world. They have the most landfills. That's a business. It's so hard to get more landfills approved, yet they're becoming more and more valuable. They're expensive to manage. However, scale helps. So Waste Management is a wonderful compounding company. I'll have the fast graphs up here. As you can see, what is it? We're at 17 out of the last 20 years with positive EPS growth. Most of those years, it's double digit. This is a very boring company. We all know what they do. They pick up your trash, they go put it somewhere else, and you pay them money for that. That's a service that you're going to pay somebody money to do in any economic environment. Same thing for businesses. There's nothing you can do about it. Nobody wants trash heaps piling up. And there's also local ordinances and environmental regulations that make you have to pay for these services. So to me, this is like a fast growth utility. The yield's obviously lower than an electric utility, but there aren't the same sort of state regulations put on a Waste Management. So I think the upside is higher. Shares are trading for like 29 times now. I think that's expensive. Here's a fast graph once again. This stock is always expensive. It's very rare that you get to buy these shares for less than 20 times earnings. So once again, I've got the 25 times here, Mark, and you can see on a forward basis, that's $215. That's because they're expected to grow 14% next year. That's kind of right where we're at now. So if you want to look a year down the road, I think you could buy these shares now. You might sacrifice 1 year's worth of returns, but if you're going to hold these things for 10, 20 years, et cetera, to me, that might be worth it. But that's kind of 22 times area. That's the long time average on a forward basis. That's about $190 per share. So if Waste Management fell another 10% from here, I think it would enter kind of a pretty solid buy territory. And so it's just something to be on the lookout for. This is a company We talk about sleep all night. Every time I get an opportunity to buy these shares, I'm very happy. Sometimes you buy something and you get that kind of buyer's remorse, a little bit of regret, a little bit of anxiety. Should I have done that? More or less. The only regret I've ever had with Waste Management is just not buying more. I wish I owned more shares. It's not one of my larger positions because shares are always expensive and it's rare that I get to buy this company, but I'm kind of learning that I'm not going to make that mistake again. The next time that this thing dips down to like the 20 times area, like it did back in COVID, I'll back up the truck, so to speak, and, go pretty heavily into this one. I would love this to be like a top 20 position in my portfolio. It's not yet, but, maybe in another 10 years it will be. So those are my three picks: Microsoft, diversified technology, S&P Global. Focus on high margins and really focus on just the expanding debt load that we're seeing across the world and the fact that that is a duopoly. And then Waste Management, turning trash into treasure. I just can't imagine a world where that's not going to happen. So this is a kind of a boring company, but one that has made investors a lot of money in the past, and I think that will continue moving forward.
Great pick, number 3, Waste Management. I've got a good friend and a really wealthy investor here in my hometown, and he sold his business to Waste Management years ago. I mean, decades ago, probably 30, maybe 40 years ago. And he ended up partnering with Huizinga, of course, after Waste Management, into Blockbuster Video. And I'll be writing about Blockbuster Video this week and another daily articles here at widemoatresearch.com.
There you go. Well, and quick, that you actually reminded me. I didn't put this. I'll put up this chart now that Brad brought it up. One of the reasons I like Waste Management so much is because this, like REITs, is a highly fractured industry. As you can see here on this chart, Waste Management's got about a 20% market share. There's about $100 billion worth of waste management companies in the United States that they could acquire. They've been doing that for years, like they did with your friend, and I suspect that they'll continue to do that moving forward. So this is a big M&A story. Once again, kind of the rich get richer scenario here.
Yeah, for sure. And, I was actually just looking at the chart. I couldn't go all the way back 30 or 40 years, but I was looking at fast graphs, and I just clicked on as far as I could go back, Waste Management. And if you had bought in to today, and I think it went back 25 years, the compounded, the CAGR on that was something like, or the total annualized total return was about 11%, almost 800% total return since going back 25 years. I mean, I don't know what he would have made. And I thought to myself, if he would have just owned the stock in Waste Management and not reinvested, what would he be worth today? But this particular individual has made many multiple investments in a lot of different sectors. Right now, he's in the subprime car lending business, which seems to be a real profitable business. But at any rate, Nick, thanks for great job here with these swans. I'm going to try to move quickly to my 3 swans. And Nick, the first one, you're very, very familiar with this. You should have probably done this. And that is Visa, dominating the digital payment revolution. Nick, you're familiar with Visa, right?
Yeah, look, it's my 8th largest holding right now. So yeah, very, very familiar with Visa. Like the company.
All right. Well, you know this, but for our audience, in 2024, the average U.S. cardholder completed 257 transactions per year. Think about it, 257 transactions per year. That's around 154 million transactions per year, or over 6.4 million credit card transactions every year. Now, of course, we like Visa using this card because they're quick and convenient. They also come with fraud protection. They're responsibly managed, and they appeal with cash back rewards. So we know the benefits to owning Visa. In the last 12 months, Visa has processed nearly $14 trillion of transactions. That makes it the largest publicly traded payment processor in the world. Nick, I know you've talked about this a lot and wrote about this a lot.
Yeah, I like Visa because people think Visa, they think credit cards. They think, oh, they must be offering Brad money to fund his purchases, and there's a risk. What if Brad doesn't pay Visa back? Well, that's not how this works. Visa does not carry any of this debt. They partner with banks or with technology companies, et cetera. All they do is collect fees on these transactions. So, that $14 trillion, Visa's collecting a very, very small percentage of that, but it's a very low risk cash flow. They're like just a digital toll booth. That's what I call them. And I love that about them. So yeah, you hear Visa, don't think credit card, just think toll booth. That's all it is. But it's a toll booth that people trust. The fraud protection is the reason this business exists. When you swipe your Visa, you never worry about it not going through or your money being stolen, et cetera. that's what happens across the globe. And that's why this company's been doing so well for so long.
Yeah, when you talk about a Tollbooth, this company has generated profit margins of 57.4%. That's in the most recent quarter. One more benefit to Visa in this business model is that inflation is typically favorable because higher prices translate into higher gross dollar volumes, which are processed by Visa, which also trickles down to net revenue and adjusted earnings per share. So again, this is a great stock to own in this environment we're in right now. Analyst consensus, I'm going to pull up fast graphs here, but analyst consensus for Visa is 12.5% annually through 2027. The company beat expectations in all but one of the last 20 quarters, and that was the third quarter of 2024. And analysts are likely to still underestimate the company. So relative to that 1.2% yield, now again, we're not talking REITs today, so we're in some lower yields, but relative to this 1.2% yield of the S&P 500 index, Visa only pays 0.7% dividend yield. So again, compared to the S&P, which is low, speaking towards REITs, Visa has a less than a 1% dividend yield. However, Nick, it's one of your largest holdings, dominant balance sheet. They've got a AAA minus S&P credit rating. There we are using S&P again. So now at the current price, Nick, I haven't really spoken to you obviously before this. My three picks actually, I'm recommending buys today. At the current share price, these is around $340 a share. That's a forward 12-month PE of 26.6 times, well below the 10-year average, which is 29.5 times. It's not a bargain, but I certainly think you can certainly nibble or add some shares to Visa. We think there's possibly 13% upside through 2026. Nick, what are your thoughts on valuation?
Yeah, I don't think it's not a bargain here, but I think it's fairly valued. This company's never cheap. I mean, if you look at that fast graph, it got down to 23 times earnings in 2022. But other than that, I mean, it's 25 times or more throughout the last decade. And you mentioned the low yield, but it's important to note that it's growing the dividend at 15 to 20% a year. So, I've held this company for a decade, and I think my yield on cost is like 6 or 7%. So, in the next decade, we're talking, potentially like 10 to 15% yield on cost for those shares I bought a decade ago. That's the type of growth that you get with a company like this that you don't get with the REIT. So, no, if you need money now, Visa may not be the best income-oriented stock, but if you have a long-term investment horizon, I love companies that are, return so much money to their shareholders like this company does.
Yeah. So let's move on to my Swan number two. And this is really another interesting company that could be referred to another Tollbooth type of business model. So we all know the demand for data centers today. I'm going to pull up a snapshot here or illustration. This is Goldman Sachs showing the demand of data center consumption. You can see this is a CapEx chart showing the CapEx from 2029 for hyperscale companies all the way to 2026. So the demand is there. And according to Goldman Sachs, the US data center electricity consumption will jump by an estimated 165% from around 4% of total consumption to around 10% by 2030. So again, this is a utility company that really utilizes this toll booth type of reference for these data centers. So put another way, the consumption could skyrocket from less than 200 terawatt hours in 2023 to as much as 500 terawatt hours by 2030. So Xcel Energy, this company serves 4 million electric customers and more than 2 million natural gas customers in 8 states. It's a major regulated utility. It's perfectly positioned to cash in on the ongoing AI revolution. Now, Nick, I know we've got some utility stocks in our newsletter, in our front end portfolio. Just curious, what are your thoughts on the utility space as it relates to AI and data centers?
No, I think huge demand here. I mean, you covered it. We saw just today, it's Monday at about 11 a.m. today, news broke that NVIDIA was investing $100 billion into OpenAI to develop, I think, 10 terawatt hours worth of data centers. So we see $100 billion here. Last week, it was Oracle a couple weeks ago. Their stock went up 40%. We're seeing just stupid amounts of money being thrown at data centers. So if you can time that up, there's a lot of upside, but the kind of very baseline picks and shovels play there is electricity producers. So I was considering GE Vernova for my list because I agree. Energy is, you can't have AI without energy. they're just so expensive today. They're, 100 times earnings. I love that company. It's been probably the most money I've invested this year, but I can't do it at this valuation level anymore. So I was trying to find an energy company I liked, and I just couldn't fit it into my top three. So I'm glad you did, because I think, with my whole fall asleep today, wake up in 10-year type mindset, energy consumption's only headed one way, that's higher. And so I do like all these utilities. They've had a great, 24 months in the US right now. But if the Fed cuts rates, that's just going to drive demand to them from income-oriented investors. For the last, 18 months or so, money's capital's been flying into that sector because of this AI boom. But pretty soon, it's also going to be just income-thirsty investors that, if bond yields fall down to 3% or something, they got to go somewhere to get that cash, and utilities is going to be where they head. So it'll be a, kind of a two massive demand, flows headed into that sector. So I do like utilities, over the next several years, at least, and then certainly long-term as well.
Yeah, of course, the cat's out of the bag. We are going to see a rate cut. We heard that last week with the Federal Reserve. I'm going to pull up this fast graph here. You can see we've got a S&P rating again, a triple B plus, so a very strong investment grade rated company. You can see here that using, again, fast graphs again, the company is supposed to deliver around 6% to 8% annual growth going forward. As you can see, again, the fast graph illustrates the earnings per share rise from 8.1% annually through 2027 off a 2024 base of $3.50 per share. Also, Xcel has a 3.2% dividend yield that's very well covered, roughly 50%, high 50% range. So that gives plenty of room for that dividend to keep growing. You can see the current price is $72 a share, trading at a forward PE of 17.8 times. So this is considerably less than the 10-year average, which is 20.4 times. So we think with the dividend yield, with the growth forecast, and with the multiple expansion, Xcel could deliver total return around 18% through 2026. So we've got that one on the buy list. Again, it's not a huge bargain, but definitely something I would buy today. Now, third pick is a little bit off the page here. Again, I'm not going REIT. I know we've focused on REITs for the last two episodes. So this one, I'm going to go over to the gold space, which is really an interesting business model. A lot of people like gold. And this is Royal Gold, a very high margin cash flow machine. Of course, they primarily are focusing on the precious metal. And of course, this is a royalty business. So they have this stream of royalty. That's kind of the sweet spot for this company. And they're big enough to be trusted by these mine operators, but small enough to keep posting very strong growth. Royal Gold has $12 billion in market cap, which is in the middle of the pack in that overall industry. The company has 171 property interests in Canada, the US, Australia, and other countries around the world. The minimal operating risk and limited capital costs for this company support these Visa-like profit margins that I just discussed earlier. In the second quarter of 25, Royal Gold put up a 56.7% non-GAAP net profit margin. This is what happens when a company of this size, and they only employ 30 different people across 4 offices, so very low G&A costs. In July, the company announced agreements to acquire Sandstorm Gold and Horizon Copper. These deals are expected to close in the fourth quarter. So upon completion, Royal Gold will add 40 additional producing assets to its portfolio. Beyond the near term, the portfolio will have 47 development assets and 266 assets in the evaluation and exploration stages. Now let's pull up this fast graph. Now, 49.4% spike in EPS in 2025. You can see that on fast graphs. That's amazing to see. The consensus expects 18.5% uptick in 2026. So 49.4% in 25, 18.5% in 2026. The balance sheet is also extremely strong. The company had $248 million in net cash and $1 billion undrawn on its credit facility at the time. Now, dividend yield is not huge. Again, we'll talk REITs again soon, but this is only a 1% dividend yield, so it's not huge. However, the payout ratio is in the low 20% range, and that puts the company in a very sweet spot to continue dividend growth in the future. Valuation is also attractive. As I mentioned with these other two, currently shares are trading at $1.91 a share with a forward PE of 21.4 times. This is less than the 10-year average PE ratio of 47.2 and 14% under what we consider or I consider my fair value range of 223. So this meets all of these tests. I know a lot of people aren't familiar with this company, but we think this company could generate around 20% upside through 2026. So definitely put this one on your radar. It's definitely a Swan, or maybe a Swan B, we'll call it, on the list. So Nick, we've got through these 6 picks today. Again, looking forward to next week. And again, I want to talk to you. I guess we'll talk next week. You're 3 for 1. So we definitely need to have a shutout next week. I'm really disappointed that you gave up 3 points.
Yeah, no, well, that's okay. It's bye week next week, so just practice this week, so we'll heal up a little bit. But yeah, in 2 weeks we'll talk about the game again. I hope it's another blowout. We'll see. And I did want to mention Royal Gold. So yeah, it's not a company I follow, but I like that business model. We were very consistent today on picking high margin Tollbooth like businesses. It's a lot easier to own the land and collect money for somebody else doing all the work, right? That's the same thing that Visa does with money. That's similar to what Microsoft kind of does with their cloud business. So, if anything, that's what investors, I think this video should do. Go find these high margin Tollbooth like businesses, very high cost per employee, et cetera, and just sit back and enjoy the ride. The yields aren't high, but that's because the growth's so high. So thanks, guys, for watching this video. If you have any suggestions, please leave them in the comment section below. I'm always happy to research new companies. I'm sure Brad is as well. Please like and subscribe to the channel. We're on our way to 10,000 subscribers. It's going to happen soon. Maybe not this week, but that'll be a big milestone for us. So thank you guys for all the support, and I look forward to talking to you guys next Thursday.
Have a great week and happy Swan investing.
Thank you for tuning in to this week's episode of the Wide Moat Show here on YouTube. If you enjoyed our content, please like and subscribe to our channel and leave a comment. We'll be sure to get back to you ASAP. Also, please sign up for the Wide Moat Daily. That's our free daily newsletter at widemoatdaily.com. That's where you'll find Brad and I's insights on all sorts of things published every day in the evening. So thank you guys for stopping by, and we'll see you next week. Happy Swan investing.